Welcome back to WealthWise AU, Part 8. Today, we're going deep. Not into hype, not into stock tips, not into get-rich-quick nonsense. We're talking about something that quietly determines whether you build wealth or slowly destroy it. Mastering risk. Because here's the truth, most investors never fully understand. It's not returns that make you wealthy. It's surviving long enough to compound. And survival is about risk management. Let's get into it. Most people think risk means losing money. They picture crashes, red screens, panic headlines, markets in turmoil, billions wiped out. But that's surface-level thinking. In investing, risk is simply the probability that your outcome differs from your expectation. That's it. It's uncertainty. Volatility is movement. Risk is permanent damage. If your portfolio drops 15% but recovers over time, that's volatility. If you panic sell at the bottom and never re-enter, that's risk. If you invest in something you don't understand and it collapses permanently, that's risk. If inflation quietly eats your savings while your cash sits idle, that's also risky. Risk isn't loud. It's subtle. It compounds quietly, just like wealth does. Here's something most Aussie investors learn the hard way. The market doesn't destroy disciplined investors. Emotions do. When markets rise, people get greedy. When markets fall, people get fearful. And both emotions lead to poor decisions. Buying at extreme highs, selling at extreme lows. Risk isn't just in the asset, it's in your behavior. If you can manage your behavior, you cut your risk dramatically. Let's talk about the biggest risk of all. Concentration. Putting too much money into one stock, one sector, one idea, one sure thing. Every investor thinks they've found the winner. But markets don't reward confidence. They reward discipline. In Australia, we see this often. People overload on mining stocks or banks or one hot ASX small cap. It works until it doesn't. True risk management starts with diversification. Not over-diversifying into 50 random things, but spreading your exposure intelligently. Different sectors, different asset classes, different geographies. That way, if one area struggles, your entire future isn't dependent on it. Now, let's talk about position sizing. This is where smart investors quietly protect themselves. Before you invest, ask, if this drops 30%, will I panic? If the answer is yes, your position is too big. You should never lose sleep over a single investment. No one position should be able to wreck your entire portfolio. That's not conservative. That's professional. Mastering risk means controlling downside before it happens, not reacting after it happens. Another overlooked risk. Time, horizon, mismatch. If you need money in 2 years, you shouldn't be investing it in high volatility assets. Short-term money should stay stable. Long-term money can handle movement. The stock market is a long-term vehicle. Trying to use it for short-term needs creates unnecessary pressure. And pressure creates mistakes. The longer your time horizon, the lower your real risk becomes. Because time smooths volatility. Let's talk about something Australians deal with specifically. Property. Many Aussies believe property is safe. But any single asset can be risky if it dominates your net worth. If 80% of your wealth is tied to one property in one city, that's concentration risk. Even safe assets become risky when they lack diversification. Risk isn't about the asset label. It's about exposure. Now, here's where most people misunderstand risk completely. They think avoiding risk equals safety. So they sit in cash, year after year. But inflation quietly reduces purchasing power. Your money might look safe in your bank account. But if inflation averages 3 to 4%, your real wealth is shrinking. Doing nothing is also a decision. And sometimes it's the riskiest one. Smart investors don't avoid risk. They take calculated, manageable risk. Let's break down what mastering risk actually looks like in practice. Number 1, you have a clear asset allocation. You know how much is in shares, how much is in defensive assets, how much is in growth. Number 2, you rebalance. When markets run up and one part grows too large, you trim it. When markets fall and something shrinks, you top it up. That forces discipline. Buy low, trim high, without emotion. Number 3, you ignore noise. Headlines are designed to trigger reaction. Market crash fears. Recession incoming? Boom, ahead. Media makes money from urgency. Wealth is built from patience. Now, let's talk about downturns. Because they will happen. They always do. Recessions, corrections, bear markets, they're not rare events. They're part of the system! If you invest for 30 years, you will experience multiple downturns. So instead of fearing them, prepare for them. How? Keep an emergency fund. Avoid Don't invest money you need short-term. Stick to quality, diversified assets. If you're prepared, downturns become uncomfortable, not catastrophic. And discomfort is survivable. Another powerful concept, risk tolerance versus risk capacity. Risk tolerance is emotional. How much volatility can you stomach? Risk capacity is financial. How much volatility can your situation afford? A young investor with stable income has higher risk capacity. Someone nearing retirement has lower risk capacity. Your portfolio should match your life stage, not someone else's. Not a YouTuber's. Not a mate at work. Not a finance guru online. Yours. Here's something high performers understand. Avoiding massive losses is more important than chasing massive gains. If you lose 50%, you need 100% just to recover. Big losses are mathematically destructive. So smart investors focus on steady growth. Consistency beats intensity. Every time. Let's zoom out. The market rewards 3 traits: patience, discipline, resilience. Risk management supports all 3. You don't need to predict crashes. You don't need to time the market. You don't need to chase trends. You need structure. And once you have structure, you stop reacting. You start operating. Big difference. Here's the mindset shift I want you to take from this episode. Risk isn't the enemy. Uncontrolled risk is. When you diversify properly, size positions wisely, align with your time horizon, keep emotions in check, maintain liquidity, avoid you transform risk from a threat into a tool. And that's when investing becomes calm, predictable, strategic. Because wealth isn't built in dramatic moments. It's built in ordinary months, ordinary years, boring consistency. Risk management makes boring powerful, and boring builds wealth. So if you want to master investing in Australia, don't focus only on returns. Focus on protecting downside. Focus on staying invested. Focus on thinking long-term, because the investors who survive when, and the ones who react emotionally